Hi, and welcome to Until 9 Million. This is episode 9, and we are 526 weeks until 9 million. Hi, and welcome back. This week is the last episode on stocks and shares. It's the fifth installment. For now, it will be the last one anyway. So we talked about the stock market in general, shares, ETFs, things what I like about ETFs. And this week, I will talk about how important it is to invest in the long term. You could, of course, try the stock market the short term, but it's a bit like the lottery. But in the long term, it's very interesting anyway. So let's go right ahead. Now, the stock market will go up like on average over time. And when you look back in history, and although history is good, but it's not holy in the sense that you never know what's going to happen to the stock market. But if you look in history, then the stock market always has produced over time in the long term. They always have given you a profit in the long term. In the last 100 years, Dow Jones, it will given you a profit. Now, not if you look like in a period of 6 months time, but if you look at a period of like 10 years, 15 years, it actually mostly has made a profit. There's very indexes that has gone down like for 15 years straight, probably none. There's some who have stagnated, but if you see it as a very long-term investment, like 10, 15, 20 years, then the stock market is a really good place to invest, and especially if you do it through index trackers, because you take out the risk that bankers take as well. Now, if you try to put in every month some money, then you cost averaging everything, and it will probably give you a good average. So will you get really, really rich with the stock market, or, get suddenly a big jump and be rich? No, obviously not through this technique anyway. If you are lucky and you bought low and you sold high and you doubled your money, hey, good for you. But usually you get like 5, 6, 7% a year on average if you do this kind of technique. And especially if you reinvest your dividends, you might get even better results. So investing this way is not a bad way to invest. And personally, I like to keep it or do it that way. Well, that's my personal view. Of course, there's going to be many people, and especially bankers, who's going to say, no, we can beat the stock market, we can do better. But hey, it's up to you what choices you take, of course. But this has worked for me in the past. So is it a big money maker? No. Is it better than just keeping your savings in the bank? Oh yes, much better. Especially at this point in time, savings giving you maybe 1 or 2% on the savings account. Now the stock market will do way better than that, but you have to reinvest those dividends. That's really important. It's key of the whole thing. And you have to try to buy on a regular basis, which is maybe monthly. Now, obviously, if you have to invest €2,000 a month just to get those buying and selling costs off your back, well, that's really hard. Most people don't have that amount of money to actually invest every month. So luckily for us, there's companies who actually do give the opportunity to or not pay those buying and selling costs, or who just have their own index tracker and they allow you to put in like €25, $25 each month. So then you can actually see it as a savings account. So if you can actually say, I save $25 each month, and it adds up. The first month is $25, then it's $50, then $75. I mean, every month you can buy some shares with it. $25 is not that much of a saving every month. Now, if you can manage to do that, or maybe even 10, it really depends on what companies are offering. Usually there's a minimum to it. It's usually around 20 or 25. 10 is probably really low, but $25 a month is not a huge amount of money. And if you can put that way in the stock market and you could do that for 20 or 30 years, hell, you're going to see a really big increase of your value of your money. So stock market, good idea if you don't want to take the big risks, do it long term and do it careful through cost averaging and index tracking. And to be honest, so far it hasn't produced really bad results. It mostly has produced okay results. Now, that really depends also in what kind of index you're investing. If you're investing in a declining market type, then it might be a bad idea. But if you spread your investments through, companies that do all kinds of stuff, like you have a part in banking and a part in pharmaceuticals and a part in raw material production. If you spread it out, you probably won't do that bad. Okay, that was it for episode 9. So this is the end of the stocks and shares series, for now anyway. I'm not sure what I'm going to tell you next week. It might be about passive income. I'm not sure yet. I'll figure it out anyway. I also have a Twitter account, so you can follow me on the Twitter account until 9 million. I will Twitter my new episodes on that, so if you can always check it out. So if you like some finance advice, then you can follow this channel. Now, be careful. This advice, you cannot sue me with this if it's bad advice, okay? So just take your own if you follow my advice, it's at your own risk. I haven't sold you anything, or so basically this is what I do. You can follow it. You don't have to follow it, but it's you can take it at you can follow it at your own risk, of course. But to be honest, I haven't had bad results so far. I hope to see you next week. Thanks for listening. Bye.